Good morning, everyone, and welcome to our webinar today with Filippo Lanza, so founder and CIO at HI Numen Credit Fund. So today, after recent conversation with our investors and network, we thought of giving you a little bit of an overview on what to expect going into this year, 2023. So we think that given the confusion, especially on the macro side, to give you our point of view on what is the best way to construct and approach the portfolio construction in general, giving you an angle, especially on the credit side and on the macro and micro side. So Filippo will touch upon the general approach on credit. So generally speaking, we think that 2023 will be more selective on the credit side and generally opportunistic on the macro. So with that, I'll pass it to Filippo, and obviously let's try to keep it interactive. If you have any questions, just post them in the chat, and then we will discuss it along the way or at the end of the webinar. Thanks very much. Thank you.
Thank you, Tommaso, and thank everybody for being here with us. The first slide, page 3, is just a bit of overview of the strategies that we deploy inside the fund. On the top left-hand corner, obviously is the core of our strategy, which is long-short credit. Typically, we focus on credit-intensive situations where there's a lot of credit work to be done on the fundamental side. And I think this could become quite crucial going forward, as I think the market will have to become a lot more selective and discriminating on these credit picks as well as equity picks, because obviously the market will be unforgiving on some of the names that were very much flush with liquidity and cash for the last 10 years. Now things will become a little bit more difficult because obviously there is tightness on the supply of funds and the macro picture is more challenging. Specifically within that long-short credit, obviously financials is a big driver. We really like financials now in general, although obviously there are lots of situations of restructuring and challenges like we've seen with Credit Suisse, which we play quite well, and Monte dei Paschi. But at the same time, we like to think that financials are still paying a price and suffering from a discount linked to the previous great financial crisis of 2008, 2009. We actually think that with the few exceptions, like for example, the UK financial system or some of the US banks on the equity valuation side, but with few exceptions, is a pretty solid sector, while the real risk is that a lot of the imbalances and excesses of the financial system have been actually absorbed and compounded by the asset management side, for which we remain structurally bearish and short, starting from BlackRock, which is our structural short on the sector. Away from that, obviously, we got on the bottom right-hand corner, we have the idiosyncratic plays, which is when things become stress or distress. We've seen quite a few already coming up last year. A few of them we're involved with, whether it is Orpea or Brazil. We think those offer great opportunity because typically when companies go stress or distress, the discrepancy between fair value and security prices is the highest. And so it offers great entry point. And at the same time, we think the market is not really prepared or equipped in terms of skill set, and rightly so, because for the last 10 years, no asset manager had to develop many credit skills as the distress cycle was very mild. Perfect example last year has been Orpea. Bonds went down into the 15-20 range. We managed to pick up a decent size of bonds at that time, and then we've been exiting them in the 25-30 range. So we're talking about very big return on cash, very high return on cash, and the risk is relatively minor as a function of the overshooting once the crisis happened. And so great opportunities for us there going forward. And then on the left bottom hand, we see the macro opportunity, macro opportunistic kind of trading, where typically we look at a credit cycle, which we think is very much a driving force for the markets now. And then based on that, we articulate the view through liquid indexes, whether they are on credit or equity or fixed income. And then we have more opportunistic plays on that based on our credit, if you want, inspiration. I think we can move on and then go through some of the specific opportunity. I think we discussed about this a little bit. Obviously, on the idiosyncratic plays, we expect a big pipeline of stress and distress coming up. And I think there'll be a point where I think in the next couple of years, if the Goldilocks that the market is pricing now is not really materializing as we expect, and at the same time, you have a lot of those kind of corporate deadlines coming through and refinancing, restructuring to be done, it may become a bit overwhelming for the market. So I think, again, demand and supply, we may see some very, very good entry point. Obviously, refinancing cliff are unavoidable. We'll talk about macro, but overall, we're still very much in a very strong QE environment for a variety of reasons. The real QT will only happen in the second quarter of this year. So I think once that happens, we will see the real refinancing cliffs across names and sectors. We're just getting a bit of a flavor now. Names like Credit Suisse, Paschi last year, Europea, Oil Brazil, the Adani Group in India. I think there's a lot of those cliffs coming up and emerging in the next few quarters. Obviously, like I already talked about that, there's a big imbalance in terms of the asset manager's skills to be able to deal with credit intensive situation or stress and distress. Great entry point, great exit point. We've been waiting for this wave of stress and distress for a long time. I think now is eventually coming, and I think it's going to be a great opportunity for us. On the macro side, obviously, we've seen a lot of volatility in the last few years. We think there's been a lot of regime changes. We have a big regime change on the moving from QE to QT. We haven't really, fully moved from one regime to the other, but I think that move, it will be attempted in 2023, and it will create massive dislocation. With obviously a big regime change in the relation between the West and the East, this new kind of alleged new bloc forming between Russia and China, but also the competitive tension between US and Europe in terms of subsidizing the energy sector or other strategic sector. We see then plenty of air pockets, plenty of volatility jumps, and I think that would be a great opportunity for an asset manager like us, which is quite nimble, quite agile, to take advantage of that, especially if and when those macro moves are dictated by credit drivers, which we monitor very, very closely. If we move away from that, I think we can go on the macro landscape. Obviously, we're looking at four big drivers. We're looking at the Fed, ECB, first and foremost, then Bank of Japan, and then the peripheral banks and emerging markets. So on the Fed side, obviously, the market seems to be pricing a very good Goldilocks, and a lot of the assumptions that the market is pricing will have to be tested and actually supported by the incoming data, which I think is a pretty high bar for the market to perform. On the Fed, obviously, the expectations that yes, we had very high inflation, but it's coming down very quickly. It will eventually go down very, very quickly. But that would not be at the expense of growth decelerating into a recession. And if anything, the bull case is that because inflation is going to go down, but the growth is still going to be pretty resilient, the Fed will be in a position to actually pivot into the year end by actually start cutting rates. We disagree with that. We think we don't have a crystal ball, but we think the market is very much pricing a 70-80% chance of that. And I think that may be too optimistic. Away from that, one thing to keep in mind, obviously, on the case of the US, obviously, US has been entering into a QT process, but that has been largely offset by the cash management of the Treasury under the direction of Yellen, which is a very knowledgeable and very technical operator. And at the same time, perversely, by the debt ceiling, because obviously, because of the debt ceiling, the US Treasury is not able to issue new security, but only to roll the existing, that all of a sudden is creating a kind of fictitious lack of supply of Treasury bond, which more than offsetting the QT. So the announced QT in US has been very mild. Obviously, it will change as we progress into the year and as that ceiling will be resolved, even if obviously we expect that ceiling to be quite contentious and possibly to be resolved only during the months of summer, obviously excluding escalation in the war that would trigger a more unified Congress. If we then look at ECB on the next slide, the ECB is probably the one central bank that is going to be more clearly moving from QE to QT in the next quarter. There is a variety of QT implementation options for the ECB. A big question mark for the ECB obviously will be what's happening with number one, the war and the impact on the energy complex. Number two, what's happening with EDF and the nuclear energy being produced by EDF. Obviously, EDF has been having plenty of problems in France. All of a sudden, those problems were kind of managed and they went back to full production, but it's very fragile energy equilibrium in Europe right now. And that's very important for the ECB. Secondly, obviously, the effect of secondary kind of effect on inflation and the kind of, how much of fast inflation expectation move and how much of a inflation there is away from the energy complex. The problem for the ECB, obviously, is the ECB is very restricted in terms of its mandate, is on inflation, on growth. And the risk we see going forward is that the ECB will react to persistent inflation and a not so clear resolution on the war side by effectively strengthening or accelerating its QT. We remain of the opinion, and we said that to our investor base for a long time, that the size of the balance sheet for the ECB, as in for the Fed, is much more important for the valuation of bonds and equity than the absolute level of interest rates. If anything, actually in Europe, interest rate going up is a pretty positive thing, given the amount of savings, the amount of cash saving, the amount of investment on fixed income portfolios, and especially government. But at the same time, we think QT will have a major impact as we progress. And it's coming at a point where a lot of, for example, just as a benchmark, the spread compression we're seeing between different government bonds is it's not at all-time high or tight, sorry, but it's very much in the upper end of what we've seen for the last few years. If we then move to the next slide, is Bank of Japan. Bank of Japan, from a financial point of view, is probably the biggest wild card of 2023. The biggest wild card in geopolitical terms for us remain the war between Russia and Ukraine. And there we're very worried that we're going to see a lot more escalation before we see any proper settlement, with all the implication on the gas and oil prices. But on the financial side, the biggest wild card is Bank of Japan. Bank of Japan has been pretty much offsetting any attempted QT by the Fed by injecting an enormous amount of liquidity, even in a kind of unpredictable way, to defend the band, because obviously they have no limitation in terms of the capacity they can deploy to defend the interest rate band. Obviously, there is a big change there with the new Bank of Japan chairman coming in, and there is a very different government from what we've seen in the past few years. So we would expect Bank of Japan to withdraw more or less from the QE they've done. May not be entering QT, but there will be overall globally for us another big turning point to move from QE, which is what we're living through right now, to actual QT. Obviously, this is interesting in the combination of what's happening in China, obviously, because China, especially at the beginning of this year, has injected an enormous amount of cash, as they usually do because of the Lunar Year celebration. And that all together, again, reinforced the concept that we had an enormous amount of cash coming through. And that's why the kind of Goldilocks scenario has been priced in the market, also thanks to this massive amount of cash, which we see as being withdrawn progressively into the second quarter of this year. If we then move to the next one, we're going to go through what we call the falling macro angels. You all remember the fallen angels of the investment grade TMT bubble in the early 2000s. I think we expect this big tightening of monetary condition going forward to have very much many ripple effects. We've seen a bit of a appetizer with the gilt and pension crisis last year, which was probably incorrectly blamed on Liz Truss entirely, when it was probably much more structural than personal or political in its sources of and its triggers. We think there's an enormous amount of tightening coming through, and that will create issues at the refinancing side, not just for corporates, but also for big countries. UK, we think, is structurally the weakest. They are suffering from a major source of inflation, which is the Brexit exit of anywhere between 3 to 5 million employees over the last few years, and they will make inflation quite structural. At the same time, UK is very much levered through the mortgage market and real estate, and most of these rates are actually indexed to the short-term rates. So Bank of England is really facing a very challenging set of competing objectives. Within the government has limited the bandwidth to deal with Brexit, given the political intractability of that issue. And so we think, UK is one of the sectors where we remain quite negative, especially on the financial side, because we think there's going to be plenty of persistent inflation, and no matter what, inadequate macro reactions that could, come through the gilt valuation. It could come through the sterling valuation, but it will be very much felt through the security complex in UK. China remains what we call it, like a ghost giant with horrible demographics and in a very vicious cycle started on the political side. The economy has become even more controlled. There's a lot of talk about this zero COVID being removed as being a beginning of a new era of the regulation. We actually think the opposite. We think China growth for the last 10 years was very much predicated on infrastructure and real estate. That bubble hasn't exploded completely yet. There is a lot more damage coming through. We think the demographics is such that there is no real solution there short term, either in internal growth or immigration coming through. We think that's very unlikely. And within the very few sectors that are being very powerful in the economy, which is the technological sector, we can't forget that those are very much protected sectors because there's no competition in China, number one. But number two, those will be eventually even more regulated. So we see less innovation, more demographic issues. China for us remain a strategic short through credit for swap and through banks that are exposed to China. And from time to time, we play the renminbi versus either euro or dollar. There will be other countries that will be under pressure. Could be Saudi Arabia if there is all of a sudden a positive resolution with the war in Russia, in Ukraine. It could be other countries, but we do expect, like Turkey, for example, but we do expect these QT acceleration in the second and third quarter of this year to create meaningful challenges for the refinancing of many sovereigns as well, not just corporates. If we move on, we are going through like more specific opportunities we are articulating in the book on the corporate side. Telecom Italia is a very interesting name for us because it combines two big trends which are relevant now. One, Telecom Italia is a classic example of a very over-levered company, the results of disastrous M&A sequence that started in the late 90s and then eventually created what we have now, a company that is too levered, needs to dispose of assets, but at the same time is a company that very much owns one of the most strategic assets for a country, which is its telecom infrastructure. We think Europe has been way too extreme in liberalizing the markets. If you look at the amount of competitiveness that we have in, for example, the telecom market in Europe is a multiple of what we see in US, and is incredibly higher than what we see in any other country like China or other emerging markets, large countries like India. Why are we saying that? Because we think, as we see now, Europe is very much changing very fast. Because of the Russia war, because of the competition with US on the energy and the green transition, Europe will eventually progressively abandon its state aid rules and its kind of orthodox belief in hyper competitiveness. I think we're going to see a re-regulation, and eventually a re-monopolization of a lot of strategic assets. Top of the list obviously is energy, but I think we'll have the same on telecom, the telecom space. We are then very constructive on telecom, and we're not surprised that the long-term big pension plan of the world, big private equity of the world are looking at that positively, because we think is a sector is completely changed. They will get more pricing power. They will get less competitive pressure, and I think it's going to be one of the sector where, on top of the energy and the banks, we may see a wave of consolidation M&A plays in Europe panning out in the next few years. We've been liking Telecom Italia, we've been playing on the credit, on the equity, a variety of assets, and we still think there is a lot of hidden value there, as there is in many other telco assets in Europe, for the reason I mentioned. If we move away from TI, Monte is like a perfect example of the what's happening in the financial sector. We very much like financials now in terms of their ability to make money. We like the credit, obviously, but we need to be careful about interest rate volatility embedded, especially in like AT1 and other security. But as I said, banks are suffering from this discount that was associated to them during the great financial crisis. As we've seen with Monte, as we've seen with Credit Suisse, there is a possibility to restructure. There are great opportunity. We started buying the Monte bonds into the 45.50. Now they're trading close to par. We think is an M&A target, but is also, more importantly, is a company where the earnings capability is improving massively. The equity valuation are relatively cheap. The balance sheet are very secured. As I said, we think the big risk now in the financial system resides with big asset managers, where there's a massive imbalance between the duration of the assets and the duration of the liabilities, especially the one perceived by the end investors, that they think they have daily security or immediately, instantaneously liquefiable security, when it's not the case. So because of that, we really like banks. We were pretty big into Credit Suisse restructuring. We exited all of it at a decent profit. We still into Pasky because we think there's a massive upside still, probably in the 10 to 20% return on top of the carry. We will see more M&A on the banks. I think that's going to be one of the big tests for Europe. Obviously, Europe it went through the great financial crisis, but it was a relatively easy to solve solution, because the solution in a deflation environment was just to expand the ECB balance sheet, and which was costless. So there was a relatively easy solution to implement. I think what Europe is facing now is a much more formidable challenge, with competition from Russia, competition from China, an ally which is US, which is still very much focused on its own domestic agenda. So Europe is really under an enormous amount of pressure, and we think that it's as we've seen before, when under pressure is when Europe really grows and come up with a solution. And I think because of that, as I said, I expect Europe to move away from the orthodoxy of competitiveness and state aid. I see them facilitating new joint efforts, whether they're on the defense sector, whether they're on the telecom or energy sector. We expect more of that. And that's why even in the financial sector, maybe this is the first year or next year where we start seeing a decent amount of consolidation within the system. Obviously, if that were the case, obviously Europe would start trading at a decent premium. Mine is not a tactical call now. We're quite bearish as of now in the short term, but medium long term, you could see Europe, if they're really going down the unification road, whether it's on the banking, energy, or telecom, it would change dramatically the valuation of the assets. We can then move to the next one, core energy. We're very focused on the energy transition. We think, our bull case is that, as we see with COVID, when humanity is under pressure, the technological innovation is such that we can produce solutions much quicker, much better than expected. People were expecting one vaccine within 2 to 3 years. We had, almost 6 or 7 within 12 months. I hope we're going to see something similar in energy. I think the work by Putin and the behavior of the OPEC, although rational in the short term, it's a maximization of profit in the short term, but they are literally destroying their profit long term. I think they basically unleashed a wave of capex investments in the energy sector, which is massive, in an environment where computational technological advantages are such that we may see a lot more progress there than we've ever seen before. So I wouldn't be surprised if in 5 years' time we're in an environment where the cost of energy is pretty much close to zero. I don't know how we're going to go there, whether it's nuclear fusion or new renewable sources or just simply storage. We think one of the most practical solution is energy storage, and Core is in that kind of camp. We really like it. It's one of the few specialized energy storage play in Europe. We really like it. We think, if we look at it holistically, the world could very well, survive out of its energy needs just based on renewable wind and solar, as long as we had the right storage solution. There's a lot of talk about battery as a storage, but obviously that's a small storage. If we need to look at big industrial storage facility, Core is one of the few solutions. There are a few technologies which are very fascinating. They're being deployed. I think we're going to see more. Core is one which is being kind of proven, is out there. We think Core eventually will be a takeover target by one big utility. We're very much spending a lot of time on this transition. We played on the hydrogen a couple of years ago, and it was very successful. We now very much focus on storage solution, which we think is going to be one big driver going forward. But I think, like that, we'll see more. Obviously, one thing to keep in mind is I think, and I hope we will see a replica of what we've seen with the COVID for the energy sector, which would then change massively, the entire investment landscape. And I don't know if that's going to happen in 5 years or 7 years or even less than 5. I don't know. We need to monitor it, but I think it's going to be a very defining sector for us to be involved, both credit and equity. If we then move to the next opportunity, we talk about Coinbase. I'm not a particularly strong believer in crypto, but I do recognize and respect that Bitcoin is probably a much better solution than gold. If somebody wants to be able to walk around with a few millions in his pants and on a kind of memory stick. And I think because of that, I think there is an ecosystem there that is there to stay. Coinbase is probably the most regulated, most kind of presentable player, listed in US, effectively, regulated by the US to a certain extent. A lot of their competition has been destroyed. So we think, and on the balance sheet, they got almost 5 billion cash. The company is burning cash. They're not profitable, and they won't be for some time, unless obviously the market is right on the pivot from the Fed. And if we start seeing interest rate going down, probably going to see crypto and Bitcoin going back to the $30,000-$35,000. But what is interesting for us is the massive discrepancy between bond and equity. We had a situation where the bonds are fully covered by the cash on the balance sheet, but they're still trading at 50 cents, 50% of the nominal value, while the equity on the other side is pricing above or close to 15 billion market cap. We rarely seen this kind of discrepancy between the value, the discount on the cash cover value of the bonds versus the valuation of the market cap. So we place the trade, we long the bonds and short the equity. We had something similar on Tesla. We're looking at Uber. There are names where we think the valuation on the equity side is totally insane, but at the same time, the valuation on the credit is as well pretty insane. Obviously, it's very volatile. It's like a reverse convertible position, but it's something that makes a lot of sense. And I think it's, in a way, could be a leitmotif on the market for the next couple of years, where you have equity valuation, which eventually have to come down to earth. If Tesla really is nothing else than another automaker, then they'll be trading like Volkswagen, which means they got 90% to go down in terms of equity. But on the other side, if the bonds are like Volkswagen, then Tesla bonds and credit for swap should be trading much higher than where it is now, i.e. improve. So you have this kind of conundrum, it could stay there for some time, but it's also offering us great opportunity. Tesla, Coinbase being very profitable names for us on this kind of capital structure trade. And I think we're going to see more of that going forward, especially in some of these new kind of technology, new kind of sector where the company is relatively cash flow rich. They got the cash, but they got some bonds. They are not as profitable as the equity would like or would imply, but the credit is relatively safe. So you have a very dangerously priced equity, but a very attractive credit in terms of, buffer valuation and kind of recovery value. We can move away from that, and we can talk about other, special situation that we've been looking at. Obviously, energy is a big sector for us. We're spending a lot of time on that. Biggest wild card is the war. We don't have a crystal ball, but if we just look at all the data, we think there's a lot of escalation coming from the war front, and that would impact supply of gas and energy, gas and oil, sorry. We really like New Fortress Energy. There are very few dedicated pure play on the transmission and transportation of liquefied gas, which at the end of the day is probably the only true immediate solution for the energy gap in Europe. We are quite nervous about Europe, not just because of the war, but also because of EDF. EDF has been in a precarious state for some time. Obviously, they are coming, back to full production. I'm not quite sure that full production can be maintained for the next few years, and so we do expect the transportation of liquefied gas to be absolutely crucial going forward. If we move to the next one, we're very focused on the defense sector in Europe, and we think overall, apologies. We apologies. We're quite focused on the defense sector in Europe. We think ESG is going to go through a major revolution and a critical overview. And for too long, we've been classifying defense sector as ESG uninvestable. We think that will change. It will be pretty clear that if the defense sector is providing defense weapons to countries that are liberal democracies under attack by military dictatorship, obviously that would tip the scales in favor of the investment. Within defense sector is going through a structural change. There'll be plenty of demand from Europe, India, US. And we really like the sector. We like both Leonardo and Rheinmetall. We think ESG classification will change, will have to change. And it will also, the other big change we see on the ESG is the evaluation of sovereign ratings, especially China and Russia. Can move to the next slide.
Yeah, so I think before going through the performance, maybe if you guys have any questions, just post them in the chat. Otherwise, I will, if Filippo is okay, we can go through some of the questions that we received from our clients in the last few weeks, and probably going by order, first on the macro side and then on the corporate side. But starting with the macro side, I'd say it has attracted a lot of interest, this topic on the ECB given that it always plays catch up with the Fed, and whether, how essentially is the Fed going to transition from this world of QE towards QT, and in the specific, how it will balance the two instruments that has available, so interest rates and the reduction of the balance sheet. So the big question is, will the ECB become a net seller of securities or not? So considering these two weapons that has in the bucket.
Yeah, we've been asked that question quite a few times. Obviously, ECB has so far has been using the interest rate lever, but the expectation they're gonna initiate the QT in the next couple of months. Our view is that if these kind of mini Goldilocks being priced by the market is not happening in the speed which is required, we would expect ECB to strengthen their QT commitment. And that could be also coming down to selling assets. I think it's a bit premature now, but then it will be very much depending on the data. And our view remains the same, that, at the end of the day in Europe, 25 to 50 basis point increase is actually good for the economy, because there's a lot of savers that would help consumption, they will have wealth effect. There's very little leverage linked to short-term rates. And so overall, an increase in interest rate is not that negative for the economy. But on the other side, the reduction of the balance sheet, especially through the purchase of government bonds, would trigger a repricing wave across all asset classes. So we view QE as being much more powerful in terms of technical impact on valuation, as opposed to interest rate, which is probably less fundamentally damaging than what is otherwise perceived in Europe.
Okay, so I guess, what could be interesting is, as a link from the macro side to the corporate and credit side, how do you see where do you see a good chance in which sector, also to give an overview, a sort of summary on the corporate and credit side, given what is happening in the US with the Fed, and what will happen eventually in Europe. What do you consider strategic sector that could be less sensitive to this change in the yield curve, and what parameters are you looking at when you are selecting these companies?
Well, I think as we said, we really like the defense sector. We like energy transition sector, and anything that offers some sort of energy substitute in the short term, like NFE and similar names, or Core. We like the financials in Europe, because I think the interest rate move in Europe is particularly good for financial, but we very much dislike asset managers. So we're trying to be away from financials that've got too much of an asset management angle. So that's why, for example, we participate in the Credit Suisse restructuring, but we exited that very quickly, as opposed to Pasky, which we participate in the capital restructuring, but we also like to keep it because they have less of an exposure to asset management. And obviously, the one thing that we are particularly interested about at the moment is the leverage. Any companies or sector that are highly leveraged, we are quite skeptical about their possibilities in this kind of environment, where we still think QT will create, a relatively constrained supply of funds, and obviously where the issue is really refinancing. Interest rate for a lot of companies will not be necessarily problematic, because it's just a marginal increase in the cost. But for some companies, it would just be the difference between having or not having access to the refinancing. And then conversely, we very much like names like Coinbase or Tesla on the credit side, where the credit is very mispriced, very negative compared to the equity, which is very positive, and where we think that there has to be some convergence, especially on the credit long side that we have.
Okay, thank you. And I guess, we're gonna have a couple of words on the performance. Obviously, last year was a little bit of a strange year for us, and I like to go through, what could have been done better. But obviously, we remain, considering all the assumptions that we've done today, we think 2023 could be very positive for us, given the commitment to our mandate, which is to remain flexible, agile, and truly long short without any particular bias. So I guess with all the dispersion that we will expect from next year, we could have all the right conditions to perform well. But I think if Filippo gives us a recap of what happened last year, I think it will be much more clear of all the opportunity that we'll have into this new year.
I think last year, if you look at the performance there were like two big, if you want, drivers of the underperformance. The first one, you can see it starting in end 2021. If you look at November, December, and January 22, then we basically lost around 5.5%. That was because we were way too bearish, and we called the turn in the market a bit too early, probably 6-8 weeks too early. So we had very large position, both options and outright, on fixed income shorts, especially the short end of the curve, and especially names like BTP, Periphery, and so on. And then also we were very short names like some of the COVID winner, Netflix, Zoom, and so on. The problem is we were too short too soon, and that was part of the problem. That was compounded by our risk management, that we were a bit too strict in removing those shorts. And if we had kept some of the volatility on those positions, we would have probably ended up the high double digits, because the size of the shorts, and they were very much, we thought they were very much like option-like, as in relatively little downside on the premium, but obviously massive upside, which actually was the right call. But I think we were too afraid of the volatility, and we cut the position too early. That was the biggest mistake, I think, last year, because then every month we had the right macro call and macro position. We always made money on the macro every month, when it was renminbi, fixed income, equity, but we didn't have the right, we were not big enough as we should have been for the opportunity set. So that was my biggest mistake last year. Secondly, on the corporate side, I mean, that last year was the kind of year that on some of the corporate we were supposed to lose, but obviously the macro should have done a lot more. But we ended up doing too little on the macro, and I think on the corporate we had a couple of situations, specifically oil Brazil, that weighted quite heavily on the performance, with the sort of announcement of the restructuring towards the end of December. Oil Brazil, this year we're up around 2% year to date. Even after we drop like almost 1 again on oil Brazil. We mark it down to the 8 cents on the dollar now, but we've been adding to the position because we think the recovery rate on that, it could be on a base case around 30, 35 cents. Obviously, there is a worst case where they're going through like a nasty confrontation on the restructuring side. They need a lot more cash. They, dilute us even more, in which case the bonds are probably appropriate. We will stay in the 5 to 10 cents kind of environment, which is where we're marked now. There is obviously also a bull case where oil does renegotiate with Anatel their commitments on the fixed line, in which case, obviously, we could be above the recovery rate of 30. So last year we had this combination, those two things. Hopefully this year we're starting pretty well. We think the market will be there for us in terms of opportunity, and so I hope we can, do a lot better than last year. And I think the opportunity set is there, as we can see from the macro to the stress and distress to capital structure discrepancies. It seems a very prosperous year in terms of opportunity.
And so I think we almost took 45 minutes of your time. I'd say, to conclude, it would be, usually our investors and clients are used to receive the performance contribution with the breakdown of every sub performance. So I'd say going into 2023, how would you see, going by the end of this year, how do you see this performance contribution? What could be the biggest components of the sub book?
Yeah, I mean, as you can see now, obviously, this is the performance as of January. February is we adding another 1 point something percent. I mean, as you can see, obviously, we suffer on the macro side this month, sorry, last month, and this month a little bit less. The view there, I think macro should be a very, very positive contributor this year for the picture that we have. We think we're pricing Goldilocks. We think the main reason is because QE is still not happening because of Japan, because of Europe, and because of debt ceiling. And so macro, I think, will be pretty interesting for us. I think on the corporate financials, distress, I think, again, we see big opportunities in all of them. So hopefully we continue making on corporate and financials. So I hope I could annualize the performance on corporate financial for the rest of the year. And then obviously on the macro, we need not only to recover that, but I think we can do a lot better than just recovering that, given the opportunity set.
Amazing. Well, thanks very much, everyone, for taking part in this webinar. Obviously, we remain available for any communication on any other documentation that you require. And thanks, Filippo, for being with us and answering all the questions. So thanks a lot, and see you next time. Thank you.
Thank you, everybody. Thanks.